Hello everyone. Welcome to this session on banks. As a part of understanding various financial institutions which are going to play an important role in risk management, I will get started with the understanding of the banking system. So, as an agenda out here, we would basically understand the basic activities of the bank, right? What exactly is a banking system? Then we will look at the various kinds of risks that are typically faced by a bank. We will classify the different kinds of risks which a bank typically faces. Then we would look at how regulators make sure that the banks reduce their risks. So in that context, we will talk about the capital requirements of the bank, wherein we would be discussing the terms regulatory capital and economic capital. Then there is a concept called deposit insurance in some countries, right? What are the advantages of that deposit insurance? And at the same time, what could be the moral hazard because of having deposit insurance? What could be the kind of negativities that could be there because of deposit insurance being there in place? So we will have an understanding of that aspect. Then getting into the investment banking, where we know that the primary role of the investment bank is the arrangement of the finances, is the financing of different business activities. So what are the various kinds of financing arrangements the investment banks typically get into? So we will be looking at the various activities both on the terms of raising debt capital as well as equity capital. What are the different ways in which the investment banks get involved in those processes? What is their role with respect to initial public offering of the companies in IPOs? And there is a concept called Dutch auction in the IPOs. So how does the Dutch auction operate? What are the kinds of advantages that could be there with respect to the Dutch auction compared to the regular procedures of IPOs? So we will look at a numerical regarding that so that the conceptual clarity becomes much better. Then in the banking system, there are different roles. The bank could perform typical commercial banking activities wherein they may be giving loans, etc. And at the same time, they may be performing some kind of investment banking activities like facilitating mergers and acquisitions, etc. Now, what we generally are talking of here is with the multiple roles that are being performed by the banks, what could be the potential conflicts of interest in those roles that they are performing? And how can these conflict of interest be typically addressed? So we are looking at the solutions to that. Then we will move on to the accounting part of the transactions of the bank, wherein we want to try to understand what are the elements that go into the banking book and what are the elements that go into the trading book of the bank. How are these two things separated, or how are these two things linked? So that's one aspect we are going to look at. And finally, we would spend some time in terms of understanding the concept of securitization, which is otherwise called as originate to distribute model of a bank. So these are the various topics that I want to bring in as a part of this particular session, wherein the basic role of banks in the risk management activity can be understood at a high level. Now, getting started, we know that the traditional role of the banks is take deposits from you and me. They accept different kinds of deposits. Very commonly, the savings deposits, or sometimes you have fixed deposits. So they take different kinds of deposits from people like us, use the deposits to give loans again to people like us, right? That's the traditional role of a banking system. Now, as a part of the giving loans, they charge interest, and even when we have made deposits, they pay interest. But typically, if you see, the kind of interest they charge on the loans is always higher than the interest that they pay on the deposits. And this difference between the two is primarily that, let's say, when they are giving a deposit rate of 6%, obviously if they are charging 9% on the loans, this difference of 3% should cover their administrative costs, like the branch setups, the salaries that they give to the employees. So all the administration costs are covered by this 3%. And even if some of the loans do not get paid, nowadays in India we have been hearing lots and lots of loans have been written off, non-performing assets, right? So if there are huge loan amounts that are not being paid, even that has to be covered out of this 3% itself. And after doing a coverage for all these things, they have to give some kind of a return on the equity. For shareholders, they should show some kind of profits so that they continue their investments in the banks. So that is how the overall process of the banking system should be. That is the traditional role. But today we see that we can split the overall banking activity into two broad headings. One is a commercial banking aspect, which is the one that I have discussed just now, where the bank will be responsible for taking the deposits and making loans out of that deposits. Within that commercial banking, I can look at two major branches. One being the retail banking, where we are talking about small time people, small time private individuals or businesses. So the deposits that are taken are in small amounts from people like us who are private individuals or very small businesses, and even the loans that they are giving are lesser than a specific threshold. So small loans based on small deposits. So that is what is the aspect of retail banking. But when we are talking about the wholesale banking, things are moving more and more towards big corporate, right? So the services are being typically provided to medium and large corporate. So it could be like big companies, whatever are the banking transactions that they are doing with the bank, they all get into the wholesale banking. Even big fund managers, right? Lot of mutual funds and their managers, they interact with the banks quite heavily. Whatever the transactions they do are in very large amounts. So those kind of transactions, any other financial institutions, those kind of transactions which are generally very big both in terms of size as well as in terms of volume, the deposits, the loans that they are making are much bigger. So wherever the commercial banking is focusing with respect to big clients, we are calling that as wholesale banking. Whereas where the focus is on many small time depositors and borrowers, the focus is on retail banking. In wholesale banking, a few more important things that we observe is the spread between the cost of funds. The cost of funds is the deposits that they have got and lending rate, loans that they are making. the difference between the two is much lesser. In case of retail, let's say if the deposit rate is 6% and the lending rate is 9%. In case of wholesale, it may be like the deposit rate could be 6.25% and lending rate could be 8.75%. So the spread here is only 2.5%, whereas here the spread may be 3%. So in case of wholesale banking, the spread between the rate at which they are lending and the rate at which they are accepting the deposits is slightly lesser, because the administrative costs are lesser, right? Because the administrative costs are lesser, and sometimes because there are only a few large corporate clients, acquiring them and all, once acquired, they keep continuing as the client. So even the acquisition cost could be much lesser. So various costs will typically come down, servicing costs will come down. So that's the reason overall spread is much lesser. In some cases, the commercial, but nowadays if we see, these wholesale banking related losses are going much higher. In India, we have been hearing that big corporate, big personalities, they have made huge loans from the banks and absconded the country as well, right? And the banks are struggling a lot to recover the big loans that they have lent to those big personalities and celebrities. So normally we are talking about the cost of administration being much lesser in case of wholesale, but again not necessarily always. And we are also observing that sometimes banks fund their lending activity, the loans that they are giving, generally they give from the deposits that they are taking from the individuals and the businesses. But in some cases, in order to give some new loans, banks don't mind borrowing in the financial markets themselves. So apart from the deposits that they are getting from the individuals and the corporate, they would also do some kind of borrowings in the financial markets and use those borrowed funds to give the loans. Those kind of banks we are calling as money center banks. So this is all a part of the commercial banking activity. Whereas we see that majority of the banks are involved in investment banking activity as well. And in the role of investment banking, the major task is they assist the companies to raise capital. The capital could be raised in the form of a debt. So companies want to raise new debt capital or equity capital. So these investment banks, they act as advisors. They really play a role in ensuring that the companies are able to get their capital for their business expansions. So investment banking activity is majorly concerned with helping the firms to raise the debt and equity capital. They should be able to provide advice on mergers and acquisitions, do some kind of evaluations on which firms can be acquired by which firms and facilitate the process. If some kind of corporate restructuring need to be done, right, some kind of debt restructuring, debt being converted into equity, various kinds of such kind of corporate restructuring exercises if they want. All those things are typically facilitated by the investment banking arm of the banks. And in some cases, they also provide the trading, they also get into the trading of the securities, and they offer lots and lots of brokerage services to the clients who want to buy and sell various securities on different exchanges. So banks wise, now the role of the banks has typically gone up from the traditional role of just being depositors and lenders, their role has drastically gone up, where they are being now heavily involved in wholesale banking, majorly into investment banking and security services, all these kinds of aspects as well. Now, in this process, because of the various tasks that are being taken up by the banks, they are primarily exposed to three major headings of risk. Right? If I have to talk about the broad categories of risk that are typically faced by the banks, I should categorize them into credit risk, market risk, and operations risk. See, credit risk is one of the biggest risks that is faced by a bank, because the banks are very heavy into lending activities, and nowadays the banks are very heavy into derivatives activities as well. So in the lending activities, let's say bank A has given a loan to bank B, or probably to an individual B. Now if this individual defaults, if the B is defaulting, then the bank A will not be able to recover the money that it has given to B. So that kind of place where it has given a loan, it has given something on credit to the other party, but it is not able to recover that, is an example of credit risk. Similarly, in the derivatives transactions also, when the bank so let's say in derivatives, two banks have got into a contract, and it so happened that bank B has to pay bank A because of the contractual requirement, and bank B failed to adhere to that contract. That is also a kind of a default that is being faced by bank A. So in that case also we are calling it as a credit risk. So wherever it has given something on credit, but it is not able to recover that amount back, comes under the criteria of credit risk. The major risk that is faced by a bank is the credit risk itself, and what we see is, corresponding to the risks that are associated with the banks, the regulators, the regulatory bodies of the banks, they charge they put some kind of a requirement regarding the capital that the banks have to maintain to really compensate themselves against the risks, to make sure that the deposits of the individuals are not suffered because of the risks that are taken by the bank. Because when a bank has given a loan to someone, it has taken a risk that if the amount does not come back, it's going to impact the profitability of the bank very heavily, and the bank is answerable to the depositors there. So to ensure that the bank is sufficiently capable enough to pay to the depositors, the regulators typically put some kind of capital requirements against the risks that are typically faced by the banks. So because the credit risk is one of the most serious risks associated with the banks, the regulators also suggest that a good amount of capital be maintained by the bank as against the credit risk. So credit risk is majorly associated with the defaults. Then the banks are also exposed to market risk. Especially the banks also get involved in a lot of trading activities. So they also buy and sell different kinds of securities, either in the exchanges, the stock exchanges, etc. They buy, sell securities, and at the same time they can also buy or sell securities in the over-the-counter market as well. They may get into agreements with other parties and one-to-one contracts are also being negotiated. So because of these various trading activities, there is a possibility that the interest rates may have an impact on the values of those securities. So I have bought 100 shares at $100 per share. So my total value of the shares is $10,000. But let's say after some time the value of these shares has gone down to $80, making the value of my investment as only $8,000. So I have lost $2,000 in this trading activity. So wherever such kind of losses are coming up, these losses could be because of change in the interest rates, could be because of the change in the prices of either the commodities or stocks, or for that matter any other instrument. The change in the prices could have resulted in these kind of losses, or some kind of changes in the exchange rates also could have created these kind of losses. And because of these losses, because of the change in some of these economic variables, there is a possibility that the banks might have lost something on their investment. So that much of loss, whatever they have lost, not because of the loans that they have given, but because of these different kinds of activities that they have got into, the different trading activities that they have got into, is what comes under the heading of market risk. So all those activities that go as a part of the trading, they will be documented as a part of the trading book of the bank. Right, wherever they are doing a buying and selling of the securities. So when I say securities, they could be getting into equities or bonds or mutual funds or real estate or commodities. They could buy or sell anything, but not the loans. Right, so whichever are these things they are buying and selling, and it so happened at a loss, uh, those are the things that are associated with the market risk of the bank. Whereas coming to the operational risk, there are lots and lots of internal system failures, people's mistakes like fraud, or systems mistake, the network failures. Because of that also the bank may get into a loss, some kind of reputation related stuff, some kind of lawsuits against the bank. All these are associated with the operational aspect, or sometimes external events like now the demonetization that has occurred in India. It might result in some kind of operational risk, because it may result in some kind of new frauds coming up in the system. So all these could be the various kinds of risks that are typically taken up by the banks. And as a compensation or as a mitigation of these particular risks, the banks are supposed to maintain some kind of capital to compensate themselves against these risks that are typically occurring. And this capital requirements are specified by the regulatory agencies. And based on, there are different methods to compute this capital, right? The whole regulations relating to Basel are primarily involved in the process of how much capital need to be maintained by the banks as against the different kinds of risks that they are typically getting exposed to, right? Then, so in this capital context, we have two major definitions. One is the regulatory capital. As per the regulations, what is the amount of capital that the bank has to maintain to compensate against the possible risk that it is taking? So the regulatory capital is where the regulators come into picture, they require the banks to hold this much of capital for the risk that they are bearing. And this capital is typically computed based on the Basel standard. And generally, they use in the formulas for calculating the capital, we see that the regulators ask the banks to maintain some capital against the market risk that they are taking, against the credit risk that they are taking, and against the operational risk that they are taking. So, the calculation of each of these capitals is based on some kind of a time horizon. So, especially what could be the losses the bank can get into because of the credit risk that it has taken. Similarly, operational risk that it has taken. Here, the losses are estimated based on a 1-year basis, which means in the next 1 year, what is the approximate amount of loss that could occur because of a credit risk? What could be the amount of loss that could occur because of the operational risk? Whereas with respect to the market risk, they don't look at a 1-year horizon, they look at a much shorter. Typically, the 10-day horizon is what is being looked at from the Basel standpoint. So, what could be the major losses? What could be the loss that the bank can incur because of the market risk in 10 days? What could be the loss that the bank can incur because of credit risk over a year? And what could be the loss the bank can incur because of the operational risks over a period of 1 year? So, based on that, the total capital requirement is computed, and it is mandatory for the bank to maintain that much of capital as a buffer all the time. So, the intention of this regulatory capital is to make sure that the total capital that is existing with the bank is high enough such that the chances that the bank will fail to typically make the payments to the depositors, the chances of failure of a bank are very meager. That's the major intention. Should be generally less than 0.1%. So that much of capital is being set by the regulators, that the chance that the losses are exceeding the capital in a period of 1 year is 0.1% or less. So in 99.9% of the cases, the capital of the bank should be sufficient enough to meet all the losses that have cropped up in the year because of the credit risk, operational risk, as well as the market risk. So that is the way in which the regulatory capital is decided by the regulators and is imposed on the banks. Coming to the next one, which is the economic capital. So this is internal to the banks, especially the large banks. They have a process, they have a mechanism and a formula to calculate this economic capital. So this is purely the assessment of the bank. So the bank knows how much risk that it is taking. The bank knows what are the businesses that it has got into, and based on the real assessment of itself, banks use their own models, not the model that is suggested by the regulator. They will use their own model, which may be more and more sophisticated compared to what has been suggested by the regulators, and based on that they try to assess what is that amount of capital that they need to maintain to make sure that they can withstand all the possible losses that may crop up in the next 1 year. In general, this amount will be much lesser than the regulatory capital, but They have no other goal. They can't maintain this much of capital. They have to maintain the capital that is suggested by the regulators itself. But internally, they know that they are much better off compared to this regulatory capital. So they can very well manage them. They are very much they are very much secured in terms of the risk that they have taken. So they can very well compensate against all the risks that they have taken, even if all those risks can result into big losses. But the way in which the capital should be maintained, whether it should be maintained in the form of equity or subordinated debt, what is the form in which this capital needs to be maintained? Out of the total capital, how much should be in the form of equity? They call it as tier 1 capital. How much should be in the form of subordinated debt? Right? The minimum, maximum limit, they are all prescribed by the regulators, and the banks are required to abide by those rules in terms of maintaining their capital requirement. In general, what we see is large banks, they want to be very much comfortable. So they try to set their capital amounts much above the regulatory capital that has been suggested, so that even if something worst happens, even at a short notice they require raising the capital, they don't get into all those hurdles. So they don't get into the process of raising capital at the shortest notice, because that would cost them very heavily. So as a precautionary note, they try to maintain slightly more amounts of capital itself than what is being specified or stipulated by the regulators. So that's how we can differentiate the economic capital from the regulatory capital, right? Now, the next important topic for us to look at is the deposit insurance. See, in some countries, we have this deposit insurance being widely prominent, wherein we have a central agency, a central corporation like FDIC in United States, Federal Deposit Insurance Corporation. So these kind of corporations, they provide protection for the depositors, like to make sure that the banks do not default to the depositors. So some kind of protection to the depositors. So this deposit insurance is primarily a kind of an insurance to the depositors against the losses that they are going to get because of the failure of the banks. And it's a kind of a guarantee program, so that the individuals or the depositors, they maintain some level of confidence in the banks and deposit their money. Here in the United States, majority of the banks are operating in the private sector. So now the individual depositors, they need to have some kind of confidence in the banking system to enable them to deposit their funds with the banks. So to address their most common query, what if we get losses? What if the banks fail to pay back their deposits? That's the major common query that all the depositors would be having. So to address that particular concern, the FDIC is set up with a major role to insure the depositors against the losses to a certain level. Now, how does this work? The banks on a regular basis, they keep paying an insurance premium to the FDIC, which is generally some percentage of their domestic deposits. So some banks, they just pay around 0.1% of the domestic deposits, whereas some banks pay even 0.35% or 0.4% of their domestic deposits. Now this amount is purely based on how much capital does the bank is having, and how safe it is. What kind of loans did the bank give? Did it give a lot of risky loans or less risky loans? So based on that, the safety assessment of the banks is typically being done by the regulator or by the FDIC, and based on that, the premiums are being charged to the banks. So the premiums could be as less than 0.1% of their total deposits. For the banks which are well capitalized, which have sufficient amount of capital, which have addressed a lot of risk quite comfortably. Whereas for those banks which do not have sufficient amount of capital reserves, for them the insurance costs are much higher. Whereas, so that's how the FDIC really plays a role in terms of mitigating the losses that the depositors might get because of the failure of the banks. While this is a good mechanism to ensure that the depositors are secured, but at the same time, it is observed that there could be a possible moral hazard because of this operation. The definition of the moral hazard is just because of the existence of insurance. I will deal with this again more deeply when I am taking up this session on insurance, but here just giving up a single line. By definition, moral hazard is a kind of a situation where a person, just because he has insurance, he changes his attitude towards that particular aspect. Let's say I have insured my car, right, against the theft. So I have taken an insurance for my car against the theft of the vehicle. So now, just because I have an insurance, which means in case my car gets stolen by someone, the insurance company will compensate me for the loss. That is what is the insurance. But now, just because I had insurance, I will change my attitude. I will develop that negligence, and I will not even ensure that my car is locked. I am very negligent, and I don't even look at whether my car is locked or not. But if I did not have insurance, I would have very much ensured that I lock the car properly so that it does not get stolen. Now, this is the attitude associated with moral hazard. Just because I have an insurance, if my attitude towards that, if my behavior towards that object changes, that is what we are calling as the moral hazard. Now, how does it work in case of deposit insurance? Now, just because there is deposit insurance, banks will start adopting risky strategies. They will give all kinds of risky loans, right? If they did not have the deposit insurance, then they would not have got into the risky loans at all. They would have very well assessed the customer before giving a loan. But because there is a process of deposit insurance, the banks are ready to go ahead with a risky strategy. Now, on the other side, look at the depositors as well. If the banks follow these risky strategies, they would have simply withdrawn their money from the bank. But because there is deposit insurance, even the depositors are least bothered. Let the bank take whatever the risky strategies they want to take. If they are not able to pay us the returns on our deposits, we have deposit insurance. So because of this, even the behavior of the depositors is changing quite drastically. Now all these things where because of the presence of insurance, the behavior of the parties changes for the worse. That is what we are calling as a moral hazard. So what the banks can typically do by misusing this deposit insurance, they try to increase their deposit base. They give higher and higher interest rates to the depositors, and by just attracting more and more depositors, they get into giving risky loans. Now, as long as the market is good, as long as the economy is good, as long as the people are willing to pay back, they don't have any kind of a trouble. But just like the scenario of 2008, where the economic collapse has seen across the world, such kind of scenarios, especially if the worst has happened, the banks would not be in a position to pay. But in that case, if the deposit insurance is there, probably the depositors are protected. So that is where the moral hazard is coming into picture. People are not following the basic minimum cautious approaches because someone else is there to fund their losses. All these things come under the moral hazards. So to some extent, the risk has been reduced of late because different banks are charged different premiums as a part of the deposit insurance based on their amount of capital that is available with them, based on the kind of security that is associated with their loans, with their asset base. The premiums have been decided, and because of that reason, to some extent, this moral hazard got mitigated through against the presence of deposit insurance, right? So now that there is a clarity on deposit insurance, we will move on to the next aspect where we are looking at the different kinds of financing arrangements that are done by the investment banks. We have already discussed that today, when we are using the word banking, there are two major streams that we are talking of. One is the commercial banking, which we have discussed till now, but along with that, there is an aspect of investment banking. And we have already discussed that the major activity of the investment banks is to help the various companies or even the different governments to raise capital. The major role of the investment banks is to help the companies and governments to raise capital, and this capital could be either in the form of debt or in the form of equity or sometimes a mixture of both debt and equity. And during this investment banking process, there are various stages. So they originate the securities. They are the ones who initiate the process. They underwrite them. They do the risk assessment associated with each of the securities. They give some kind of ratings and gradings to the different kinds of securities. And based on their assessment, they take those securities with the investors. And the investors will invest in these securities, and that's how they provide the capital to the companies and government. So if you talk about the very, very general process, so any company which wants to raise capital, it approaches an investment bank saying that it needs some kind of a funding. It wants to raise capital. So the capital could be in the form of debt or equity or sometimes a hybrid, which is a combination of debt and equity, like a convertible bond. Initially it could be a debt, but after some number of years, the investor will have an option to get it converted into equity. So any company which wants some capital, it will approach the investment bank with this proposal, and the investment bank will initiate the overall process. They bring out the entire legal documentation for the security for this process of raising capital, and try to bring out what are the various rights of the security holder. Whosoever is going to invest in these securities. Whosoever is going to purchase these securities, what are all the various rights they are going to get? So a complete legal documentation of the same is done by the investment bank, and based on that they are creating a prospectus. The prospectus typically contains one, the rights of the security holder, right? How will this money be used? You are investing in this security. For what purpose the company wants the capital? For what purpose it would be using the same? How would the payments be made? All these kinds of things. Apart from that, it even gives details regarding the past performance of the company. How did the company perform in the past? The financial statements of the company for the future, for the past couple of years, would be presented as a part of the prospectus. And along with that, they give their opinion regarding the future prospects. Like, why is this fund typically being raised? Right? How would this fund be utilized? How much the company is expecting to get out of this expansion that it is taking up? All these things would be highlighted as a part of the prospectus. And along with that, the various risks that are associated with the company. Are there any kind of lawsuits that are there against the company? Are there any kind of cases that are registered against the company? What are the kinds of contingent liabilities that are there with respect to the company? All these things are very much highlighted as a part of the prospectus. And once the prospectus is prepared, now there will be a series of negotiations between the investment bank and the senior management of the company, so that they can structure this in such a way that this whole issue can be sold to large fund managers, right? Those are the major buyers of this particular issue. So they try to sell these securities to large fund managers. And based on all the negotiations and discussions, the price for these securities is agreed between the bank, investment bank, and the company. And once the price is agreed, the investment bank proceeds towards selling the securities into the market. So that is the typical general process that gets into if any company wants to raise capital for its expansion purposes. But apart from the regular processes, we have some specific types of processes also involved. And one such process is private placement. So in this whole process, instead of selling the securities to large set of small investors, there is a process where the investment bank can sell these securities to a small number of large institutional investors. Instead of large number of small individual investors, the bank, investment bank can think of raising this capital with a small number of large institutional investors. So directly they will approach a life insurance company and ask it to invest in this new company. Or they can approach a pension fund. Pension fund will have huge amount of money with it because of the contributions that are coming at regular intervals of time from various employees and employers. So you could see that the funds are very heavy, very huge, and they need to be invested. So the investment bank can approach a life insurance company or a pension fund and ask it to directly invest in this new company which wants the capital. So in that case, we are calling it as a private placement, because the investment bank is approaching a select few institutional investors and offering the new securities only to them. And if the deal gets through, the investment bank is going to get a fee for the capital that it is providing to the company. On the other side, it can go for a public offering wherein it is approaching small time investors like you and me and small businesses. But so if it has to fund that much of amount, we need large number of that kind of investors. So this is where the securities are typically offered to the general public. So this general public offerings, one, it could be through initial public offering IPO or follow-up public offering FPO. So if the companies are already publicly traded, means it's already gone for an IPO earlier and it is publicly traded. Now the investment bank already knows the market price of the share. So let's say the market price of the share is $1,000. What it does is the new shares for raising capital purpose, it will try to issue them at $950 per share. So generally it is issuing them at a lesser price compared to the market price. Now because of this reason, what happens, even this price which is at 1000, it will start showing a downfall. So there will be a substantial decline in the price of the existing shares also, because both of them are the same share. But existing one is at 1000 and the new one is sold at 950. So people may not be interested to retain their existing shares. There will be a lot of selling pressure that comes on the existing share, which will pull the price of the existing shares to around 950 itself. So that is one more thing that we need to be aware of. Now in public offering, again, as far as the functions of the investment bank are concerned, there are two major roles. One, either it can get into a best efforts public offering. It can play the role as in the best efforts public offering, or it can get into a firm commitment. So it can take up one of these two roles. In the best effort, as the word itself is very clear, the investment bank actually puts its best efforts to make sure that all the securities are sold to the investors. Right? It puts all its efforts, tries to sell all the securities to different kinds of investors. So it's only best efforts, no responsibility. It tries its level best to ensure that all securities are placed with the investors. And for that kind of effort that it has put, it receives a fee. And in some cases, that fee can very well be linked to the success it has achieved in terms of placing the securities with the investors. Whereas there is no commitment from the investment bank in terms of getting all of things placed with the investors. No commitment. It says that we will put our best efforts to make sure that your securities are being sold to the public, to the investors. Now, whereas on the other side, we can talk about firm commitment, where there is a strong agreement which says initially that the investment bank will buy the securities from the issuer. So it's not just playing a role of best effort. It is first buying the securities from the company at a particular price, and after that it is selling them to investors at a slightly higher price. So it has bought the securities from the company at some X, and it is selling those shares to the public at X plus delta, and that delta is the kind of profit that it is making. The difference between the price at which it sells the securities and the price at which it has bought the securities from the issuer, which is delta, that's the kind of profit. But again, here there is a risk for the investment bank. For any reason it is not able to sell the securities, it has to own those securities. Whereas in the best effort basis, there is nothing of that sort. It only tries its level best to ensure that all the securities are being sold to the investors. Even if it is not able to sell, it will not get some portion of the fee that it has to receive, but the responsibility of the ownership of the shares lies with the original company itself. Whereas here, the responsibility of ownership of unsold shares lies with the investment bank. So obviously there is slightly a higher risk in the firm commitment approach, and because of the higher risk that they are taking in this approach, the kind of fee that they would be charging when they play the role of firm commitment is much higher compared to they playing the roles on a best effort basis. Now, the initial public offering, which is talking about the first time companies going to the public. So those companies for which the shares are not already listed on the exchange and they want to raise capital from the public, they can do that by going for the public offering for the first time, and that is what they are calling as initial public offering. In general, in many cases of initial public offering, the investment bank plays the role of best effort underwriting itself. It does not get into the firm commitment based underwriting, because a few things. The price for that new firm is very difficult to determine, right? Because it did not, you may or may not find the competitors of that particular firm. The industry itself could be a new industry into which this firm is entering. The historical data may not be available of similar firms to do the kind of assessment. So every investment bank, they have their own mechanism, they have their own formula to assess what would be the value of this kind of a firm, right? And based on the overall value of the firm, they will divide it by the total number of shares that they are willing to issue to the public, from where they try to arrive at the market price per share, right? They'll try to arrive at market price per share. So that market price per share is based on the assessment of the investment bank on how the company is going to perform in the future and what would be the typical worth of this firm. So based on the worth of this overall firm, it will divide by the number of shares that are going to be issued, and based on that, the market price per share will be computed by the investment bank. Generally, the price which it sets for the public will be slightly lesser than the market price itself. So if this market price per share came out to $1,000, they don't mind setting the price at 975. So the offering price in the IPO will be 975 per share when they have really assessed that the best estimate of the market price per share is $1,000, because they don't want to take that risk that the issue will not be fully sold. So they will try to offer it for a lesser price to ensure that the 100% of the issue is typically sold to the public. Now that's one of the prime reasons. If you track the IPO, been tracking the IPOs for quite some time, you could clearly see that there is a heavy underpricing in the IPOs, right? Suddenly, after the IPO is being done and the shares are listed on the exchange, probably in the first couple of days, you see that the share price shoots up very sharply. The shooting up is quite drastic in some cases. So just after the shares are sold in the IPO, probably after a couple of a couple of weeks, when they are actually getting listed on the exchange for trading purpose, we see that the price is much higher compared to what they have been issued at during the IPO. So there is a good chance that you can make a much decent profit if you have invested in the IPOs, because the general tendency is the IPOs will be underpriced because the investment banks do not want to take the risk of the IPO not getting fully sold, the shares not getting fully sold because of the higher price. So IPOs are considered as attractive buys by many investors in the regular scenarios. But in some cases, this is one more thing that we have to be very cautious about. The investment banks, they try to offer the IPOs first to the large fund managers because they are their major clients. So they expect some kind of business from these clients in the future. And even they try to approach the senior executives of large firms, because there is a possibility that these senior executives will give them big business in the future. So there is a possibility that investment banks, in their first attempt, they would like to sell all these IPOs to the fund managers who are their biggest clients and some kind of executives in large companies whom they feel they might give large business for them in future. This is the process of spinning, and that could become dangerous in some cases, right? Probably a regulation will intervene in this process. There will be some kind of restrictions that would be put to make sure that the whole of the IPO is not going into the hands of a few select people. Spinning is very cautiously examined by the regulators as well. Now, just to avoid this kind of a situation, we have a process called Dutch auctions, right? We have a process of Dutch auctions for the IPOs. Now, just to talk about this Dutch auction, yes, once the prospectus is issued, everyone, individuals, companies, whosoever wants to buy the shares of that particular new firm, they have to indicate how many shares they want to buy and at what price they are willing to buy. So they have to give these two things. So they have to very clearly indicate the number of shares that they are willing to buy and the price at which they are willing to buy. So in the Dutch auction process, what happens is, first they would look at the price. Who has bidded the highest price and how many shares he or she has bidded for. So the shares are first issued to the highest bidder, then to the next highest bidder, and so on. So first, whosoever has bid the highest, he would be getting all the shares. The next, whosoever has bidded, if the shares are still so large in number, even the second bidder is going to get all the shares that he has bidded for, and so on till all the shares have been allotted. But here the catch is, let's say the highest bidder has bidded for $20, the next highest bidder has bidded for $19.5, the next guy at 19, the next guy at 18.75. And by the time the shares are allocated to this particular person, let's say all the shares have been allotted, because again there are number of shares that can be allotted are limited. So based on the number of shares this person has selected, this person has selected, this person and this person, by the time the chance came to this person, the number of shares that are allocated are complete. Now what typically happens in this Dutch auction process is, it does not go with this person paying $20, this person paying 19.5, this person paying 19. All of them will be paying only $18.75. So whichever is the least of all the prices which qualifies for the bid, that least price would be charged from all the bidders. the price paid by all the successful bidders. So in this case, these four are the successful bidders. Now probably there could be some people who might have bidded at 18.5 and 18. But by the time we came to this particular bidder, all the shares have been allotted. So there is no share to allot to these people. So these people are completely ignored. Now only out of these people, whosoever has bidded the lowest would be the one that would be charged from all the other bidders. The price paid by all successful bidders is the lowest bid that leads to share allocation. So in this case, 18.75 is the lowest bid that has led to share allocation. That is the price that all the bidders are going to pay. Now, because of this Dutch auction process, there are two common problems that are overcome. One, there is no question of favoritism that is shown by IPOs to investment banks to some of their favorite clients. So that process is completely avoided because everyone is submitting their bid, which talks about the number of shares as well as the price they are willing to buy, and the price that clears the market should be one single price that all of them have to typically pay. It's not the case that someone pays higher and someone pays lower. So that's where very common process today for IPOs is the Dutch auction process itself. Now, just for a quick workout, if I have to look at this specific numerical associated with the Dutch auction, the bidders in a Dutch auction are as follows. Number of shares being auctioned is 150,000. What is the price paid by the investors? How many shares does each investor receive? Let's see that. So let's rank the bidders with respect to the price that they have quoted. So this person is the first. He is the highest bidder. He is the second highest bidder. Then this person is the third highest bidder, fourth highest bidder. Then this person comes the fifth. Here is the sixth, here is the seventh, and here is the eighth. Now I have identified who are the top bidders. Now let me see, the overall number of shares is 150,000. So this person has bidded only for 80,000. So he will get all the 80,000. Then the second bidder has asked for 50,000 shares. So he will also get all of them. Now the total shares are 130,000 are already been allotted. Now the third person has actually asked only for 10,000 shares, and even 10,000 plus 130,000 is still less than 150. So even this person will have all the full shares allotted, making total number of allotted shares as 140,000. Then I look at the fourth person. This person has bidded for 20,000 shares, but only 10,000 shares are left. So this person will be receiving only 10,000 shares out here. Right? He would be receiving only 10,000 shares. That is what will make the total share allocation complete. So the 5, 6, 7, 8, they are not going to receive any kind of shares because the share allocation is complete. And now coming to the price that is paid by all these 1, 2, 3, 4 position guys, all of them will be paying $100 only. Though this person has bidded for $125, he will end up paying only $100. Even this person will pay 100, this person will pay 100, this person will pay 100. These three bidders are going to get the full number of shares, whereas this person A is going to get only 10,000 shares because those are the numbers that are left off. So that's how you calculate how many shares are allocated to each of the investors, what is the price paid by each of the investors, and something like that. Alright, I hope this numerical should be comfortable for you. Now, let's move on to the next important aspect with respect to the banks. We have already discussed that the banks typically perform different activities, like they do a commercial banking, they are involved in commercial banking where they collect the deposits and give some kind of loans. They are involved in security services. They provide lots of brokerage services to the clients. And they are also involved in heavy investment bankings. They facilitate the mergers and acquisitions. They get into the IPO process. They facilitate the companies to raise debt or equity kind of capitals, etc. Now, these are different kinds of roles that are being performed by the banks per se. Now, if you look at it, there are very many potential conflicts of interest that can come up in these different roles. Now, look at the advisory part, the securities services advisory. Now, an investor has asked a bank for an advice. Now, what will the bank do? Instead of giving a genuine advice, they try to push those particular stocks which their research team is researching on. Or, as a part of its investment banking activity, it might have taken up the IPO of some company. So, what it might typically do is when I am approaching this bank for an advice for investment, it may try to push this IPO to me. So, it may try to see that I would be convinced with the kind of recommendation that they are giving on this new IPO. They try to push that new IPO to me. So here that's a conflict of role. An investment banking role is it has to ensure that it has issued the securities to the public and it has helped the firm raise the capital. But in that process, it is catching hold of all those investors who are approaching the bank for investment advice and forcibly trying to push those IPOs or those tasks for which the company has, the investment banking firm has typically taken up the exercise to these customers. And especially when there is a fiduciary account, in some cases there is a possibility that the client has given full responsibility to the investment bank to invest the shares on his or her behalf. In those cases, all those securities that are getting difficult to be sold, because investment bank takes the responsibility of selling the shares of the IPO. If there are some shares that are getting difficult to be sold, it tries to push them into the accounts of all these customers who have given the rights to the investment bank to carry out the trades on their behalf. So a big potential conflict of interest. Similarly, okay, let's assume a commercial banking operation. Bank has given some kind of a loan to a company, and because of the loan that it has given, there is a possibility that it will get some kind of confidential information about the company, right? Because it has given a loan, it has to really assess so many inside parameters of that particular firm. So because of that, it obtained so much of confidentiality information regarding the firm. Now, ethically speaking, this information has to be kept confidential. But because it also has an investment banking division, there is a possibility that this information can be passed to the investment banking division, where the people in the investment banking division can try to evaluate this firm based on the confidential information that they have received for potential mergers and acquisitions. So they might help some kind of a company which wants to acquire by passing on this confidential information of this particular company to that company so that the acquisition can be done, and in the process they can charge a huge commission. Now these are the conflicts of interest that we are talking of. Even in case of security services that the company is providing, the team will keep doing a lot of research on different securities. Now, they might, so as a part of the recommendations that they give after the research, they may have to give a recommendation with respect to buy the shares or sell the shares of a particular company. Now, generally, they don't want to give a sell recommendation because it might very well hurt the sentiments of, it might very well hurt the relationship between the company and the investment bank. So generally they may not be interested in giving a sell recommendation. They may want to give a buy and a buy kind of a recommendation so that the company's management will be pleased and they give them more and more better business in future. So the investment banking business can come from them in future. So they want to maintain that instead of giving a sell rating on that particular company, they would be interested in giving more and more of a buy rating. Similarly, let's assume that a bank has given a loan to a company, but because of the confidential information that it has got about the company, it wants to get away with the loan, right? It wants to get rid of the loan as much as possible. Then it can very well approach its investment bank, ask the investment bank to create some kind of securities out of the loan and issue them to the public, get into the process of securitization, and in a way exit out of the loan virtually. So that way what happens is, by having multiple divisions, by having some kind of confidential information from one division, there could be a loss of misutilization of the roles, which can result in the confidence in the banking system going down quite drastically. Now, to address all these conflicts of interest, some companies have attempted to separate both the commercial banking from the investment banking altogether. And in the United States also, we have seen the Glass-Steagall Act of 1933, which has limited the ability of the commercial banks and investment banks to cross each other. So very limited chance of investment bank getting into a commercial banking activity and a vice versa. But so during that Glass-Steagall Act scenario, the commercial banks were allowed to do the typical commercial banking processes. They can do the underwriting of the treasury instruments and municipal bonds, which are some of the investment banking activities, but they are not allowed to engage in public offerings. So the roles were typically cut. They can do private placement if required, but they cannot get into the IPO process, the commercial bank. It's only the investment bank which should have got into the process of IPOs. Similarly, from the investment bank's perspective, they were not allowed to act like commercial banks where they can take the deposits and give some kind of loan. So the roles were clearly separated between the commercial banks and the investment banks. But as the time progressed from 1933, there were a lot of amendments and improvements that have happened to that particular act. 1987, there were some kind of relaxations that have come out, that which says a company could be a holding company. I can set up myself as a holding company and I have two subsidiaries. One is a commercial banking business, the other is the investment banking business. And so these are the two subsidiaries. But there is a small clause that has been put that the investment banking subsidiaries, the revenues of this should be a small percentage of the overall group's revenue. So that's one more thing that has been kept as a part of the restriction in 87. But in 97, there are few more relaxations that have happened, which says that even at this point now the commercial banks can go ahead in terms of acquiring all the existing investment banks. Whereas in 1999, there is a Financial Services Modernization Act which simply eliminated all the restrictions that were put, which means there were different banks which were doing both the commercial banking as well as the investment banking activities. But there were 5 major banks which did not get into commercial banking at all. They have positioned themselves as hardcore investment banking firms, 5 of them. So there was a Lehman Brothers, there was Merrill Lynch, then there is Bear Stearns, Goldman Sachs, and Morgan Stanley. All these 5 the top-notch banks, they did not get into the commercial banking activity at all. They tried to position themselves as core investment banks itself. But in 2008, all these five have really got into some kind of troubles, which marked an end of the era for investment banking in the United States. We know that the Lehman Brothers got bankrupt. Bear Stearns has been taken over by JP Morgan Chase, Merrill Lynch taken over by Bank of America, and even Goldman Sachs and Morgan Stanley, they started getting into the commercial banking activities as well, in addition to the investment banking interest that they have already held. So they have got into the regular commercial banking activity as well, got into setting up as a holding company and getting into both commercial banking as well as the investment banking operation. So now you hardly see any bank which is exclusively into investment banking activities itself. Now, nowadays, to address this conflict of interest scenario, the banks have come out with internal barriers, which are typically being called as Chinese walls. So it's a kind of a virtual barrier, both resources wise, the location wise, lot of other things. So there is a lot of even the information technology wise and everything. So no information is transferred from the commercial banking division to the investment banking division or vice versa, especially if it is not in the best interest of one or more bank's customers. So the information is virtually shielded. And if there is the conflict of, if there is a violation on this particular conflict of interest rules, we have seen so many cases where heavy fines have been levied on the companies and the banks, and even huge lawsuits also came into picture. So the banks are utmost careful that they don't want to engage themselves into breaking these Chinese walls altogether. Because from a bank's perspective, it's the confidence in the banking system that is very much necessary. A particular bank has to earn a lot of reputation to ensure that people are coming to it to make their deposits, to take loans, etc. So the reputation is the most important and valuable asset to a bank. And if they are getting into the activities which will violate the conflict of interest, that can have a very serious repercussions on the confidence of the bank, and this may again in turn result in a huge business loss. So banks generally don't want to get into these activities, so virtually they are trying to resolve their overall conflict of interest problems. Now, coming to the next topic, which is majorly to do with the accounting aspects of the various transactions that are done by the bank. I am trying to bring in the two important books which are maintained by the banks, the banking book and the trading book. So when you are talking about the trading book, everything relating to the trading operations. They are buying and selling different kinds of securities. So the securities could range from equities, bonds, mutual funds, derivatives, real estate, commodities, any of them. So all the kinds of assets and liabilities that the bank is having with respect to its various trading operations, they are documented as a part of the trading book. Now, the important point here is whichever the entries have gone into the trading book, the value of all those entries has to be marked to the market daily. So they have to reflect the daily change in the price. So if a bank has purchased 100 shares of a particular company at $100 a share, so initially the value of the asset is 100,000 or $10,000. But tomorrow if the price of the share goes down to 98, then the price of the asset is directly becoming 9,800. So which means they are getting into a loss of $200. So this is what we are calling as marking to market. Every day based on the price of the underlying the whole value of their investments and liabilities have to be evaluated, and whatever it is, it could be a gain or a loss that has to be reflected on that day itself. So the gains and losses are recorded immediately, even if the company or the bank does not have any kind of an intention to sell that asset. So anything that has gone into the trading book, the valuation of that has to happen on a daily basis, which is what we are calling as marking to market. And based on that, whether there is a loss or a gain, the same has to get reflected and recorded in the financial statements on that day itself. Though the intention of the company is to hold them for quite some time, but because it's there as a part of the trading book, the details have the profit and loss details have to be updated on a daily basis. But sometimes what happens is some kind of contracts that they have got into. See, if they have bought the shares, especially the equity market related purchases, we know the share price on a regular basis, so the gains and losses can be documented quite heavily. But if there are some kind of, let's say, over the counter derivative contracts that they have got into, or some kind of a special contracts that they have got into, for which there is no historical data at all, probably that could be the unique transaction that they have got into. Now in those cases, there is no market where you can really assess what could be the typical price, right? And there is no liquidity, no buying and sellings happening, no transactions happening on a regular basis. So because of that, or the product could be very, very complex, which is the unique of its kind. So finding out the market value of the transaction could be very, very difficult. In that case, it is suggested that the company or the bank has to create a virtual model, a kind of a formula based on some set of assumptions, and the marking should happen against that model. So the gains and the losses need to be computed based on the model. If the liquidity is not there, if the market prices are not available to do the marking to market on a daily basis, then it is suggested that the gains and the losses are updated based on the marking to model. So a model is created based on the various assumptions, and on a daily basis the value needs to be computed based on the model, and on that basis the profits or the losses have to be updated in the records of the bank. So that is what goes as a part of the trading book. To a large extent, the entries that are there in the trading book, they are very heavily exposed to the market risk. Whereas when it comes to the banking book, it's a big sequence of all the loans that the bank has made to the small, large corporations, individuals. So there is no market for this. So the entries are not marked to market here. So here only when the payments are received, only when the new loans are issued, there only we are seeing the changes that are coming into this account. So on a daily basis, we don't need to compute the market values, and based on that we don't need to update the book, right? So this banking book is not marked to market on a daily basis, but trading book is, yes. Now here let's consider a couple of scenarios. Let's assume that the borrower is up to date on the principal and the interest repayment that are being done. In that case, that kind of loans are typically recorded in the banking books at the principal amount plus accrued interest. So whatever interest is yet to be paid, so the typical recording of the interest as well as the principal is recorded in the banking book, assuming that there is a regular payment. Whatever is the interest that is yet to be received, what is the principal that is yet to be received, these two are combined together and the value is noted in the financial statement, especially if the borrower is up to date. But in case sometimes the borrower did not pay, borrower is supposed to pay on the next installment on let's say 1st August 2016, but he did not pay until the 1st December 2016 or 1st November 2016. 90 days is already over. Even if 90 days is over beyond his due date, he did not make the payment. Now in that case, that particular loan will be treated as a non-performing loan or a non-performing asset, NPA. Now if it is a normal loan, in the banking book, it would be treated as principal plus accrued interest. This whole amount will be shown as a part of the banking book in the assets of the firm. Whereas, in case it's the payment has not come for the last 90 days beyond the due date, then it would be treated as a non-performing asset or a non-performing loan. So the accrued interest will not be considered for the calculation of the profit. Whereas in this case, the accrued interest is also considered for the calculation of profit, but here the accrued interest will not be considered on the calculation of the profit. Now, even worse, right? Forget about the interest being paid on time, forget about 90 days delay. Now, if the problems are even more severe, probably I may not get the cash back at all. This is where the banks can write everything as a loss. That is what we are calling as write-off. Nowadays there is a lot of discussion that is going on with respect to the write-offs of some of the loans issued to the so-called premier celebrities in India, so-called premier businessmen in India, where big loans have been given and there is a serious problem with respect to the collection of the principal against that loan. So in that case, the loan is classified as a loan loss and there will be a write-off associated with that loan. So the banks would typically book them as a losses, but again that may not be removed from the overall banking books altogether. They need to have a reserve for the loan losses, and if they have set a reserve, then it's a kind of a charge that they are putting on the income statement for the estimate of the loan losses that are going to be occurred. So a clear differentiation between the banking book and the trading book is very much essential, because even the capital calculations are based on the entries that have gone into the trading book versus the banking book. So we need to have a good amount of understanding regarding the same. Then coming out to the final concept of this session, which is the concept of securitization, otherwise called as originate to distribute model of a bank. Here, the banks actually initiate the loans, right? We have talked about banks initiating the loans with the deposits. So whatever is the pool of money that they have got, against this pool they have initiated the loans, but they don't wait until the loans are repaid. That's a traditional process. At regular intervals, the interest and the principal on these loans are paid, and after some period of time, the loan is completely paid off. Now, so during this entire period, the banks typically do not have the necessary liquidity. The loans may be long-term loans, and by the time they recover all the money from all the loans, so during that period, they may not be in a position to issue fresh loans. So this is where we talk about all these loans, which are typically the assets of the bank. They are packaged, and so these are packaged into different tranches. We call them as senior tranche, subordinate tranche, or a mezzanine tranche, or a subordinate tranche. Some kind of categories. So this is more secured, moderately secured, and least secured kind of categories. So the overall assets are split into two or three categories, and having this as the pool now, based on this pool as a backup, securities are being issued for the investors. So investors can invest by these securities. So investors are providing money because they are investing in these securities. So this money is again going back to the bank immediately. So whatever is there in the form of the loan collaterals, that is getting converted into cash because of this securitization, which means they are in a position to reissue some more loans, because that old set of loans which were illiquid, now they became liquid, and they have got converted into cash, because using those loans they have sold some kind, using those loans as the collateral, they have issued different securities to the investors and raised capital from the investors. So that is what is the typical process of securitization. I am not going into the complete details of securitization here, but you could understand it is originate to distribute. We have initiated, the bank has given loans, but it is not keeping the loan until the whole payment period. It has distributed it. That particular loan is distributed to various investors who have purchased the securities from the bank based on these loans as the collateral. So the securities are created from the cash flow streams originated by the bank. So as and when the bank receives the principal and the interest from the borrowers, that principal and interest will be passed on to the investors. So from the bank's perspective, it's a very, very attractive model, because the loans that were typically illiquid, the assets that were typically illiquid, they were able to convert them into liquid cash, and because of that they can give more loans now. So they have removed all that loans from their existing balance sheet. They got cash out of it so that they can give money more loans. So their business is growing at a much compounded rate. So they are, and even because of this, the capital requirement has typically come down, because now they are no more heavily exposed to credit risk, and because they are not that much exposed to credit risk, because their loans have been come out. Now there is no more loans as a part of their balance sheet. So their credit risk has actually come down, and because the risk has actually come down, their capital requirement also has come down. So they got more and more free capital. This free capital again can be used for lending much more. And in some cases, one, they can get a fee for originating the loan, and even if it is servicing the loan, in that case also an additional fee can be charged. Now, in the US mortgage market, this has been one of the innovations towards the end of the 20th century. So there are various government sponsored entities like Fannie Mae or Ginnie Mae or Freddie Mac. So these kind of various government sponsored entities, they are buying pools of mortgages. So different kinds of loans that the banks have initiated, these government sponsored entities have bought all those pools of mortgages, and they have converted, or they have repackaged all those mortgages into different cash flow streams, otherwise called as tranches, and they have sold them to the investors. And because of that, they have got into the process of guaranteeing the timely repayment of the interest and the principal. So in this case, the bank is not taking any kind of a risk. It's the investors who are taking the risk. And because if the borrower has defaulted, there is a good chance that the investor of these securities will not be getting the principal and the interest that he is supposed to get. Along with that, the investor is even exposed to a prepayment risk, because in case of mortgages, what can happen is, if the interest rates in the market have gone down quite drastically compared to the time when I have taken the loan. Let's say when I have taken the loan, the interest rate at which I have taken the loan is 10%. Now the interest rates have come down to, let's say, 7%. Now in this case, what could very well happen? I still need to pay at the rate of 10%. Whereas now a fresh loan, the person who has taken the loan afresh, he may have to pay at rate of 7%. So what I can really think of is, let me close this existing loan and let me open a new loan at 7%. So this is where I may think of repaying or prepaying the loan. And when I am prepaying the loan, now the bank is not getting these proceeds. These proceeds are going to the investors who have invested in the securities created out of the loan. Now this money which the investor is receiving, he does not know what to do with it, because he was expecting a 10% for the next few years, but now he has got the money. He sees that the market rates are much lower, so overall he is at a big loss. The risk is taken by the investor. Now, so from the bank's perspective, they have tried mitigating their risk by getting into this kind of a process. But of course, because of these things, again there are a lot of moral hazards that have come out, right? So the banks, they did not, because there is a kind of an insurance that is being provided by the government sponsored entities where all the loans are getting bought. The banks did not give enough care to underwrite the loans. They did not take enough care in terms of scrutinizing the worthiness of the borrowers. How good are the borrowers? They did not do a risk assessment of the borrowers. So they started giving so many loans which are subprime. Right? They did not assess the credit quality of the borrowers. They just started giving the loans under the assumption that these loans can be sold again back to the government sponsored entities and they can raise fresh capital. As long as the economy is doing well, things were much better, but once it started a downfall, the downfall happened quite drastically, which we had seen in 2008, the one of the biggest economic crises and financial crises that has typically cropped up. But this model per se, it has been used not just for mortgage. Even the student loans got packaged, commercial loans got packaged, commercial mortgages got packaged, credit card receivables got packaged. So in all these cases, the instruments that were created based on the cash flows out of all these assets, they are being issued to the investors. The investor is bearing the credit risk because of this packaging. If the original borrowers have defaulted, it's not the banks that were losing out, because the banks have already repackaged it and they have sold it to the investors. It's the investors who have lost very badly because of the defaults on all these various loans. So one of the major innovations in the banking sector, the concept of securitization or the originate to distribute kind of a model, though it has though there were a few misutilizations of the same, this can very well be regarded as one of the revolutionary models that have come up in the banking sector towards the last decade, towards the end of the 20th century, and it has gone even into the 21st century as well. So these are some of the various topics that I wanted to discuss as a part of the understanding of the banks. We had a good amount of discussion on each of these topics in detail. I hope you got a good amount of understanding of all these aspects. In case you have further clarifications on any of these topics, you can very well get in touch with me by giving me a call on the number that I have given below, or you can very well send in an email at the email address that I have provided. Thanks a lot for listening to this session. Thank you very much.